Hey, we're gonna come back here today. We got some good follow-up questions from our webinar on Tuesday, and we'd just like to address a few of them here today on a quick presentation. The first thing we want to address in here right now is, as we look ahead, the number one thing we need, and we didn't put this on Tuesday's webinar, is that we need flexibility. I mean, we have to admit we don't know whether a corn is going to be $4 or $9 this fall, and we don't know where diesel prices are be at. Heck, we could have anhydrous at $500 or $750 a ton. It could be at $2,000 a ton this fall. What we do know, though, is that things are going to be extremely, extremely volatile. Then when it comes to managing your risk, again, we have all this uncertainty, but there are some things we do know, and what we really want to do is protect our dollars per acre. I think this chart in front of us really shows the challenges that are going on. If you look at the two red lines, they're spaced between 325 and 425. And if you go back from 2015 to 2020, essentially December corn spent over 90% of our time in that range. Now in 2021, that range jumped up to $2 a bushel. And if you go back to 2012, from the low to the high, the range on December corn was $3.50 a bushel. As we look ahead to 2022, we need to expect that this volatility from the high to the low on corn could be anywhere from $2 to $3.50 or even $4 a bushel. Now, one of the big challenges this year in marketing, and we've addressed it on a report in here before, is the increased cost on managing risk. What we're just highlighting here is the higher initial margins. You can see corn a year ago, it was just under $1,000 to put on a contract. Now it's a little over $2,000 just on the initial margin. The wheat is even a bigger extreme in here right now, as it was a little less than $1,500 a year ago. Now it's close to $7,000 just for the initial margin of one contract. This is going to increase cost of doing business, interest rates running up. Cash flow needs are also increasing as well. This is kind of a margin, a call sheet that we've used before when advising elevators and what to charge for a hedge to arrive. And normally on corn, we would project, hey, we're going to have a dollar range. You figure 6% interest, you got a half cent a month, on interest expense, and that's where we went into a new crop hedge to arrive. They'd charge a nickel a bushel and figure they would have their costs covered. The challenge today, though, is instead of looking for a dollar move against us, we're probably looking at things could potentially move $3 or $6. This is increasing the cost of managing your risk, and part of the reason why we're fearful that cash basis levels are going to continue to widen out as elevators struggle and have increased costs to manage that risk. I want to get back to some questions that we had following Tuesday's report. So here's just that farm example we again used on Tuesday. And then here's that simple marketing program we put together where we're selling 2/3 of the cash and then buying 1/3 back with a call spread to offer us some flexibility in here. And what we really want to highlight right now, and what we're trying to get guys to focus, and as we've followed up with this, getting them just to take a step back at these numbers, that we want flexibility, whether if corn is at $4.50 this fall or at $9. Well, you can see with this marketing program, if corn is at $4.50 a bushel, you'll end up with about $5.76 as your average. Or if corn's at $9, you're going to be at $7.46. The challenge is to have enough crops sold that if the market ends up going down, we still have an acceptable return. On the other hand, still have enough bushels left over to price out that if market is sharply higher, that we can still move our average up, because if we have $9 corn this fall, our input costs are going to go up. The other thing what really helps us too is when we look at the dollars per acre that we're protecting. With this particular strategy, if corn's at $4.50, we're still ending up with $1,150 an acre gross on our corn. If corn's at $9 a bushel, we're at $1,500. This is one thing, we use as a good base to look at here, because you might be a producer saying, hey, if I'm averaging 200 bushel, if I can put a floor price in place where I'm grossing $1,000 an acre and I want more upside potential, then that's a marketing plan that would fit more of your needs. Now, as we're going to wrap this thing up in here today, I think the biggest thing is you got to have a plan, okay? And it really doesn't matter what a plan is. I know there's an old saying that a bad plan is better than no plan at all, because at least you can adjust. I kind of agree with that. But on the other hand, just start off with a halfway decent or a good plan. The other thing is doing nothing is a choice. I mean, if you want to do nothing, that's fine. And it comes down to what's important to you: more downside protection or more upside opportunity. This next week we got a stocks and acreage report, and the one thing we find just a bit funny that's changed in here recently is a week ago it was all drought talk in here, and all of a sudden we come near this week with a cold, wet end of March. It's like, man, could we have planting delays? I know I had a producer remind me today that the first week of April a year ago they had a third of their corn crop already planted, and talking about some chances of snow in the forecast here this weekend. So things change. We're going to wrap it up here today and announce our scholarship winner. We had applications from 4 different states. How we judge it. I'm involved with 4-H and showing livestock, and I got to tell you, pick the video that hit us the hardest. So we'd like to congratulate Kelly Hernus from Wisconsin for winning our scholarship. It was an awesome video, and we're going to look at sharing that with you as well.